With the new year begins the tax saving season. While fundamentally it's not the right approach to focus on your tax savings only during the Jan-March period. It should instead be a year-long activity, but well, that is how it is. And as people become active towards their tax saving, they start looking out for the best tax saving or equity-linked saving schemes to invest and save taxes. Hello and welcome to our channel 5-Minute Finance by ET Money, where we discuss the basics of investing in personal finance. So in today's video, we'll talk about the top 5 tax saving or ELSS funds that you can consider investing in 2025. So for new investors, let's quickly get on to understanding what ELSS funds are and who should or should not invest in them. ELSS mutual funds, or the tax saving funds as the name implies, helps investors to save taxes under Section 80C of the income tax. They have to invest at least 80% of their assets in equities, now be it large cap, mid cap or small cap companies. And they come with a lock-in period of 3 years. So anyone who has opted for the old tax regime and is looking to save taxes under Section 80C of the income tax can consider investing in these funds. Now those who have opted for the new tax regime, you may skip investing in these funds as tax savings under Section 80C does not qualify under the new tax regime. Next, let's quickly understand how we took out the name. So let's take a look at the methodology. We tried to incorporate both consistency of returns and volatility while taking out the best funds. So we started with looking at the 7-year rolling returns of all the tax saving funds in the last 10 years. That is from November 2014 to November 2024 period, rolled on a daily basis. Now there are 43 tax saving schemes. Now, as we looked at the 7-year rolling returns, funds which have not completed at least 7 years of existence were automatically filtered out. So we were left with 33 funds. Now for beginners, rolling returns is like calculating trailing returns, assuming you are investing on a daily basis, or you can say it is like a daily SIP for a certain interval and then taking an average of the series of returns. So as per the methodology used by us, if I say that the 7-year rolling return for Fund A is 17.5%, it means that we took out the 7-year return for all the 7-year periods that existed in the 10-year time period between November 2014 and November 2024. So we got 2,464 instances of returns, means there were 2,464 7-year periods between the 10-year time frame considered. Now, the average of all the returns obtained for these 2,464 instances is the 7-year rolling return of Fund A, which is 17.5%. So we filtered out the funds that had delivered higher than the category average returns. Next, to factor in the risk portion, we checked for the 7-year rolling standard deviation. Standard deviation measures how much a mutual fund's returns deviate from its average. For instance, a mutual fund has a standard deviation of 3% and an average return of 10%. The fund's returns could be between 7% and 13%. So standard deviation measures volatility of the fund. Higher the standard deviation, the more volatile the fund would be. Coming to rolling standard deviation. So it works the same way as rolling returns. Just like we calculate daily returns for a certain time period in case of returns, here we calculate standard deviation on a daily basis for a certain time period and then taking an average of thousands of instances. That is termed as rolling standard deviation for that period. Now we took out the schemes that have a 7-year rolling standard deviation of lesser than the average 7-year rolling standard deviation of the category. This gave us the schemes that have been less volatile than other schemes in the category on an average. So basically, we filtered out the schemes that have delivered 7-year rolling returns higher than the category average while being less volatile than the category. And this gave us our list of 5 tax saving funds. We did not rank these funds. We are revealing the names as per their size. So let's start with the biggest fund. Managed by the veteran fund manager Nilesh Surana, Mirae Asset ELSS Tax Saver Fund is also the third largest tax saving fund holding assets worth Rs 25,000 crore. It has delivered a 7-year rolling return of 19.21%. Now coming to how much money this fund has made for its investors. So if you had invested 1 lakh in this fund 5 years ago, it would have nearly tripled to 2.8 lakh by now. And a 10,000 rupees monthly SIP in this scheme for 5 years, where you would have invested 6 lakh rupees till date, would have grown to a massive 10.9 lakh rupees. Now, if you want to invest in any of these schemes or any other schemes of your choice, you can do that on the ET Money app by paying 0% commission for absolutely free. In fact, you can evaluate any fund of your choice on the app using an amazing surprise tool. So do explore the ET Money app for mutual funds and other investment options. Okay, coming back. So then we have DSP ELSS Tax Saver Fund, which is also the fourth largest fund in the ELSS space and has delivered rolling returns to the tune of 16.38%. Now, in terms of amount, so 1 lakh rupees invested in it 5 years ago would have again close to tripled to 2.93 lakh. And 10,000 rupees monthly SIP for 5 years would have grown your money to 11.73 lakh rupees. Next, we have Motilal Oswal ELSS Tax Saver Fund managing assets around 4,000 crore. It has given rolling returns of 16.2% in the 7-year period. And if you had invested 1 lakh rupees in this fund 5 years ago, you would have more than tripled your money to 3.28 lakh by now. And a 10,000 rupees monthly SIP started 5 years ago, where you would have invested a total of 6 lakh rupees. You would have grown to massive 13.92 lakh rupees. With 15.82% 7-year rolling returns, we have a relatively smaller fund in the list, PGIM India ELSS Tax Saver Fund, which manages assets worth 769 crore. And if you had invested 1 lakh in it 5 years ago, you would have made 2.64 lakh by now. And a 10,000 rupees monthly SIP continued for 5 years would have made you an amazing corpus of 10.47 lakh by now. Next fund in the list is Tata ELSS Tax Saver Fund, which has delivered a 7-year rolling return of 14.97%. Coming to how much money this fund has made for its investors. So 1 lakh rupees invested 5 years ago would have become 2.5x to 2.57 lakh. And a 10,000 rupees monthly SIP for 5 years would have grown to 10.87 lakh rupees. And with this, we have come to the end of this video. We have taken out the best funds in other categories of equity funds as well. You can find them all under a single playlist, Best Mutual Funds to Invest in 2025 on our page. And I'll be back with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.